All right, today we are diving deep into the second quarter earnings from BJ's Wholesale Club. And more importantly, we're going to try to make sense of the market's reaction, which was, well, frankly, pretty baffling.
So here's how we're going to break it all down. First, we'll look at the market's instant reaction. Then, we'll unhack the numbers hiding under the surface. After that, we'll get into management's playbook for a nervous consumer. We'll also cover their guidance. And finally, we'll wrap it up with our analyst take in the next call.
Okay, let's set the scene. The date is August 22nd. BJ's reports their numbers, and the market, well, the market delivered a swift and pretty punishing verdict.
And this is where the confusion starts. You've got this classic tug of war. On one side, earnings per share came in strong at $1.14, which was a solid beat. But on the other side, total revenue at about $5.4 billion actually missed what Wall Street was looking for. So a really mixed signal.
And this was the result. Not just a little dip, a massive 8.5% drop in the stock by the time the market closed. I mean, that is a serious reaction. But here's the real kicker. It's not just that the stock dropped, it's how it dropped. It plunged on trading volume that was 4 times its daily average. You know, this wasn't just some casual selling. This was a high conviction move. So the big question is, why? Why the panic? To figure that out, we've got to dig a little deeper. Let's get into our next section and really unpack the numbers that were hiding just beneath those headlines.
Okay, so this is probably the number that freaked everybody out. The big headline number for comparable sales, a super important metric for any retailer, it was actually negative, down 0.3%. Yikes.
But hold on, because that number is seriously misleading if you don't factor in something called fuel deflation. See, BJ sells a ton of gasoline, and when gas prices are lower than they were last year, it automatically drags their total sales number down, even if they're selling just as much stuff inside the club. And here's the real story. Once you strip out those volatile gas prices, BJ's core merchandise business, it actually grew by a healthy 2.3%. And get this, that growth was fueled by their 14th straight quarter of increased customer traffic. So people are definitely still showing up. And they're not just showing up, they are signing up in droves. Another huge win for them was hitting a massive milestone. 8 million total members. To put that in perspective, that's a 55% jump since they went public just 7 years ago. And this chart really shows that it's not just about the quantity of members, it's about the quality. The percentage of people choosing their more expensive, higher-tier memberships just hit an all-time high of 41%. And these are your best customers, the most loyal, the highest spending.
The CEO, Bob Eddy, he really hammered this home. This membership growth is the absolute engine of their business model. That fee income, which was up 9% by the way, is super high margin, and it gives them the stable, predictable profit stream that most retailers would kill for.
And one last thing on the numbers. Their digital business is just on fire. We're talking a 34% surge in digitally enabled sales. Members are clearly loving services like buy online, pick up in club. This is a huge piece of their growth story now. Okay, so if the core business numbers look that good, what on earth did management say that could have spooked the market so badly? That brings us to their playbook.
And here it is. This is the key. Management basically said the American consumer is feeling frustrated and cautious, and they were seeing this change in behavior across the board, even from their higher income shoppers. That hints at a much wider economic anxiety.
And this wasn't just a vibe they were getting, they had the data. They saw customers using more coupons, switching to BJ's own cheaper store brands, and really pulling back on the big, non-essential stuff like lawn and garden items. It's a classic sign of people trying to stretch every dollar. This quote right here pretty much sums up their entire strategy. They're looking at things like inflation and potential tariffs and saying, you know what, we're going to play it safe. They decided to be super careful with inventory, ordering less of the discretionary stuff for the rest of the year, even if it means potentially missing out on some sales.
But don't think they're just sitting back and waiting. They're also playing offense with a big project called Fresh 2.0. It's this huge data-driven makeover of their fresh food section. They started with produce, it's working, and now they're rolling it out to meat and seafood. It's a smart long-term play to keep people coming in the door. All right, so let's shift gears and see how all of this, the cautious consumer, the careful inventory, translates into their financial forecast for the rest of the year. Now this is where the plot thickens. Despite all that cautious talk, despite their conservative strategy,
management actually went ahead and raised their full-year earnings guidance. This is a huge signal of confidence. It tells you they believe they can manage their costs and squeeze out profits, even if sales are a little soft. It makes that massive stock drop look even stranger, right? So, time to put all the pieces together. We saw a solid earnings beat get absolutely punished by the market. So, what's our call on BJ's from here? Really, the whole debate for an investor right now boils down to this. Did the market totally overreact to a soft revenue number and some cautious commentary? Or did it correctly sniff out some deeper cracks in the growth story that just aren't obvious yet?
Our call on this is market perform. Here's the thinking. Their membership model is a fortress, and their digital growth is fantastic. But you have to weigh that against the fact that their core sales growth is lagging behind some bigger competitors, and those headwinds in discretionary spending are very real. The stock looks pretty fairly valued right now, so we think it's wise to wait for a clear sign that top-line sales are picking up speed again. Now, for a wild but plausible trade idea, you could consider a bearish option strategy, like buying puts ahead of the next earnings report. The logic there is to bet on the market's clear sensitivity to their top-line number, thinking that any weakness next quarter could cause a similar overreaction.
And as we always say, remember, this is not financial advice.